Hello everyone, I'm Eng Guan, one of the partners in All Quant. So this year we have been receiving many questions regarding bonds, right, which have performed quite badly. Now that is understandable, right, as many people have exposure to bonds as part of a diversified portfolio. So in this video, what I'm going to do is I'm going to address a few commonly asked questions, right, along the lines of like what is happening now, why bonds behave the way they did, and whether bonds as an asset class are still relevant going forward. Alright? Okay, now the first question. So why are bonds also falling together with stocks this year? Now bonds, especially government bonds such as US Treasuries, are often regarded as safe havens. So typically during a crisis when the stock market crashes, people tend to flock to bonds, and as a result of that the prices rise. But very clearly this is not what we are seeing this year. So in fact, stocks and bonds have been falling hand in hand together, right, for the most part of the year itself. Now, as you can see from this chart here, right, stocks, be it large cap or small caps, and bonds, whether it is government bonds, corporate bonds, investment grade bonds, high yield bonds, or even treasury inflation protected securities, right, which I'll touch on briefly later. Okay, so they're all in the red this year. And what is the underlying cause of this? Alright, the main driver here is inflation, which has been ramping up since 2021 and staying in persistently high and dangerous levels. Now, many things lead to where we are today. For example, we got over a decade of money printing, there's the demand and supply imbalance in the midst of COVID-19 recovery that we are in right now. There's also the Russian-Ukraine war, which is still going on, as well as increasingly protectionist policies between the West versus the China, etc., etc. Okay, but we're not going to debate on this here. So the bottom line is inflation is bad. And why? Right? Because it erodes the values of all your future cash flows and earnings. So it impacts stocks, bonds, or any securities that produces cash flows in the future, while including, say, the income that you get from your job. Now, fixed income securities are particularly vulnerable. And why is that the case? Because as the name implies, they are fixed income, right? So their cash flows in the future are fixed. So let's say if you buy a 10-year bond that pays a 3% annual coupon, right, using $100, it is going to pay you the same amount every year, $30. Okay, so no matter where the inflation is. Stocks, which are businesses, right, they still have the means to raise prices and then pass on some of the effects of the inflation to consumers. Your salary, which you get from a job, can also get adjusted. Right, but for the case of bonds, the absolute amount of money you'll be getting from the bond you hold is pretty much fixed. So that's why bonds are particularly vulnerable to the effects of inflation. Okay, then the next thing about inflation is it will push the US Federal Reserve, right, to hike rates aggressively in order to bring inflation down. And higher rates are also negatives for both stocks and bonds. Why? Because it makes the cost of running businesses and purchases higher. And it also makes your existing bonds, which pays lower coupons, a lot less appealing. Now, let me go into a little bit more depth on how bond prices fall when inflation rises with a simple illustration to make things a bit more clearer. Now, suppose you bought into a 10-year bond that pays you a fixed rate coupon every year. Then, at the end of 10 years, you will get the principal back. Now, when we want to price this bond in order to know how much it is worth in today's value, we can sum up how much those individual coupons and the principal repayment at the end of the 10 years are worth today, like summing up all the individual cash flows. Okay, and of course each of their value, right, will be worth less in today's context. Now you've heard of this before, right? $1 now is most of the time worth more than $1 in the future. So if I give you a choice of whether you want to receive $1 now or whether $1 1 year down the road, you're almost always going to pick, I'm going to get $1 now, right? Because we all expect to be compensated for the time taken, the risk taken, as well as other effects such as inflation. But as certain, right, at a point of a time where we make the decision. Alright, and if you do follow the logic, then the further out those cash flows are into the future, the lesser it is going to be worth today, right? So this is what happens. So if inflation increases, then market participants, right, expects these future coupons to be worth even less in today's context, and all this gets priced into the market. So as a result of that, right, bond prices falls. Now, inflation and interest rates go hand in hand, so they're tied together. And one of the key objectives of the US Federal Reserve is to maintain price stability. Now, a moderate level of inflation is actually a desirable characteristic of a healthy growing economy, as long as your wage growth and productivity are also kind of in line or keeping pace with each other. But when inflation starts to spiral out of control and then stays high, so Federal Reserve will be forced to step in to increase the interest rates to cool the economy down so as to slow the demand, and in turn bring the inflation down before it becomes like more entrenched and starts to cause more extensive damage. So this year, right, Fed embarked on a rate hike path that is progressively more aggressive each round. So we started the year looking at 25 basis point hikes, then in March we moved on to 50 basis point hikes, and right now we're looking at 75 basis points. Okay, so you can see on this chart here, right, how the market implied Fed funds rate have shifted from March to June. It is basically just one way up. So in March, the market is kind of expecting the Fed funds rate to hit about 2.5% at year end. Then just 3 months later in June, the market expects about 3.6%. Okay, so this is more than 1% higher, which is quite a big deal to bonds, because even though the Fed funds rate are like very short-term overnight interbank borrowing rates, they do have some impact, right, on the yields of bonds that has a longer maturity as well. Alright, so this is how the yield curve looks like from March to June. So the curve basically shows you the bond yields and the markets across the bonds of different maturities at specific points in time. So the yields on the short end of the curve, like a 3 months, 6 months, or a year, right, are rates that are more sensitive to the Fed funds rate. But the further out you go, right, say in the 10-year, 20-year, and so on, then those are more influenced by market expectations, because the duration of those bonds are stretched much longer into the future, and the market may expect different conditions then. Okay, so that's why sometimes you can get an unusual phenomenon of inverted yield curves, where the short end of the curve, such as the 1-year or the 2-year, are higher than the 10-year. Okay, and that is often taken to be a sign of a recession coming. But under normal operating circumstances, yield curves are usually what we call the upward sloping, meaning the longer the maturity, the higher the yield you will get. Right? It's kind of like putting your money into a 1-year fixed deposit versus a 10-year fixed deposit. You would naturally expect to get higher interest rates, right, for the 10-year, because you're locking up your money longer. All right. Now, as you can see from here, right, the yield curve have also been moving up along with the Fed funds rate curve. Okay, so that naturally gives a negative impact or a downward pressure on the bond prices. Now, let's look at what increasing rates and yields causes bond prices to fall. Right, let's use a simple example. Let's say you bought a bond for $100 and this bond pays you a 2% coupon every year. Now, if nothing changes in the market and the interest rates or yields still stay the same, okay, then theoretically you can still sell this bond off for $100 on the market. Okay, now what if the interest rate changes? Let's say it increases and now new bonds, right, are issued with 3% coupons. Okay, in this case, do you think you'll still be able to sell your existing bonds off for $100 at the market? No. Alright, clearly the answer is no. Because no one in the market wants to be shortchanged. Why pay $100 for your bond, which only gives them 2% every year, when they can go out and purchase the new bond, which gives them 3% at the same price? Okay, so no one is going to buy your bond unless the price goes lower, such that effectively they're getting the same yield as the new bond, right? So that's why bond prices fall when interest rates or yield increases. Alright, now with this, I hope you have a better understanding of why bonds are so severely hit in this current environment. Alright, now the second question we're often asked is this: why are Treasury inflation protected securities, or in short, TIPS, also down in 2022? Now, for those who do not know what TIPS are, basically these are bonds that adjust for the effects of inflation. Okay, they're typical or traditional bonds that we invest into, such as your US treasuries or corporate bonds, typically do not have such mechanisms in place. Okay, and these traditional bonds are also called the nominal bonds. Alright, now TIPS are offered in 5-year, 10-year, or the 30-year maturity, and very much like their longer term nominal counterparts, they also pay semi-annual coupons. That means they pay out twice a year. And in addition, right, TIPS are actually in almost every aspect similar to a nominal bond. its coupon rate is also fixed as well on issuance. So how then, right, does TIPS adjust for inflation? Right, it does that by adjusting its principal every 6 months. Okay, so this principal is indexed to the CPI. So the CPI is your consumer price index, which is a price measure on a basket of consumer goods and services. So if your CPI goes up, which suggests inflation, right, then the principal of your TIPS goes up. But if your CPI moves down, suggesting a case of deflation, then the principal of your TIPS get adjusted down as well. Alright, so even though the coupon rate actually remains the same, the actual coupon amount is now calculated on a larger principal when there is inflation. So you'll be receiving more in terms of your coupons. Okay, and on maturity, right, the TIPS will pay you back the adjusted principal or the original principal, whichever is higher. Okay, so this in a nutshell describes what TIPS are and how it is different from a nominal bond. So if that's the case, right, shouldn't TIPS be doing well now when inflation is high? Well, it is not as straightforward, okay, because TIPS is ultimately still a bond at its core and is also affected by where the interest rates go. Alright, so it kind of comes under the twinned or dual effect of inflation as well as interest rates or yields. Now, as mentioned before, right, so with higher inflation, TIPS principal get adjusted upwards more and you get more in terms of coupon payout. And on maturity, right, you also get back a larger principal when there is inflation. So these are kind of positive for TIPS. It pushes the prices up. But you got to remember that at the same time, right, because yield rises, well, TIPS will also come under pressure and its prices will fall just like any other nominal bonds. And this portion here has a negative impact on TIPS. So at any one time, these two forces are at play, and it depends on which impact is larger. As is the case that we are seeing now, it seems like the negative impact, right, from the rising rates more than offsets any positive impact coming from inflation itself. So that is why within 2022, you're seeing that TIPS is also down, well, although it still performs relatively better than the nominal counterparts. Alright, the third question is this. Are bonds no longer relevant as a safe haven to be used for diversification in the future? Now, to answer this, we have to understand that markets move from one regime to another through different market cycles all the time. So what you see here on the slide is a very broad segregation of the regimes into 4 quadrants according to different levels of growth and inflation. Now, bonds, right, does its job best during the disinflationary bust regime. Okay, so basically in this regime, these are typical of a recession where the economy declines, where unemployment rate is high, and this is also the type of environment where you can expect the Federal Reserve to come in to cut interest rates and introduce monetary stimulus to support the economy. Alright, and even during the disinflationary boom period where it usually coincides with the early growth stage, the Federal Reserve are still likely to be pursuing a loose monetary policy to support the recovery process. But during this stage, bonds can also still theoretically perform. Okay, but in the other two regimes where we talk about here, right, the inflationary boom and the stagflationary period, well, these are periods where inflation can potentially run very high and the pressure to ramp up the interest rates also tend to be higher, particularly in the late stage of, let's say, the inflationary boom itself. Okay, but you got to recognize that it is not just the bonds that are going to feel the heat here. Okay, the entire or the whole economy is going to feel it, right? And on the extreme end and towards the later part of it, it can potentially tilt the regime back into a recession where then demand subsides and inflation comes back down. And then we'll be back here again, right, in the disinflationary bust stage. Okay, so if we end up in this quadrant again, we can expect again bonds to perform and behave as a safe haven again. Alright, so every asset class has its place within the different regimes and bonds are no exception. Now, rare behavior doesn't imply that it's abnormal behavior. So the bonds are just behaving as per what they should be doing right now. Now, stagflation is one of the main concerns when the year starts. Everybody fears that we're moving into another stagflationary era. So, and many people are thinking whether they should be pulling their money out from the assets that they hold and then parking all of them in the cash. Right, it is a difficult question to answer, okay? So the best thing we can actually do is to draw a reference back from the 1970s, where we experienced deflation during that period of time itself. Of course, it doesn't mean the same thing will repeat, but it is definitely something for us to reference and work on. So the chart here, right, actually shows you how stocks and bonds actually performed during the stagflationary era back in the 1970s. Interestingly, and probably also contrary, right, to what many people thought, but over this entire period itself, both stocks and bonds actually still, right, deliver you positive returns. Okay, surprised? Right? But of course, there are significant up and downs along the way, right? But over the whole period itself, both actually achieve a CAGR of more than 6%. CAGR is your compound annual growth rate. Right? However, do note that inflation is much higher here, right? Inflation averages about 8% per year back then. So technically, you're actually still poorer than when you had started. But had you parked your money, right, cash during this entire period, you would definitely be worse off, right? Because you would not have made a single cent back then. Okay? Alright, so we just looked at what happened during the stagflationary period in the 70s. Okay, but at the same time, I think we should also be aware that stagflation is not so much a natural regime, right, so to speak. So inflation, okay, is pretty much a supply and demand issue. So you can work on either one of them to resolve it. For example, you can work on resolving the supply chain issues, where to restore the balance, or they can work on slowing, right, the demand down in order to control inflation. So declining growth, right, and economic contraction that happens during recession, where demand actually falls, are in direct opposition to the forces that supports inflation. So it is kind of quite difficult for both to coexist over long periods of time, right, without any external factors at play. So in the 70s, the situation was kind of unique because there were many other factors behind the scenes. Right, of course, there is also the loose monetary policy back in the early 70s, which probably sowed the seeds, right, for the high inflation that followed. But at the same time, there were other things, right? There were US government were imposing price controls on wages and goods, which not only did not help, but worsened the situation. Then there were strong union labors that were pushing for wage increases. Then there was also the OPEC embargo that happens in 1976. And OPEC controls more than half the world oil supply then. Okay, and it's also during this period where the US completely delinked its US dollar from gold, which results in its currency weakening and hence worsening the inflation problem back then. Now, under most normal circumstances, we can expect high inflation as well as the corresponding rate rise that comes along with it to eventually hurt growth and possibly trigger recessions along the way. So that in turn is going to cut the demand down and bring inflation back down under control. And there will come a point in time where things turn around, where central bank stops its rate hike and eventually goes back into a cutting mode to support the economy when that happens again. Alright? Now, and where are we today, right, in terms of the market regime? And what is the market suggesting we might be moving into next? Now, based on the recent data, it seems that the market is pricing in a recession scenario, or increasingly pricing in a recession scenario. And we can see that quite clearly, right, from the yield curve. But the first thing to note is that the yield curve have moved down by quite a fair bit from June. So this solid blue line here represents the yield curve on the 11th of July 2022. And this dotted red line above it, right, is that of June. What is the yield curve from June? So you can see the longer end of the yield curve has moved down by quite a fair bit, while the shorter end, which is more influenced by the shorter term central bank actions, have moved up. Okay, so this is the first point, right? So the longer end has actually moved down because I think they are pricing in increasing recession risk. And the second thing that you can take note of from this chart is that the yield curve is actually inverted as of the 11th of July 2022, right? So if you take note of here, this is your 2-year rate. So this 2-year rate is actually higher than the 10-year rate here. All right, and an inverted yield curve has been a fairly reliable indicator of recession down the road itself. Okay, and this yield curve has actually been inverted as of 6th of July 2022 itself. Then the next question now is, does the market still expect inflation to hold up? Why am I asking this? Because for stagflation to hold, you need inflation to persist or to remain high even when the economy undergoes a decline or contraction, right? Now, we don't have much information on the supply side, but we can have some color on the demand side of things. Now, if you look at the raw commodity prices, they have come down since like March or May after ramping up or staying high for March of 2021 to the early part of 2022. So if you look at the charts here, you can see some of this picture. Right, food prices such as corn and wheat have come down. Okay, metal prices from silver to copper have also come down. And energy prices is one of the key worries, right, have also been retreating from a high itself. Okay, so again, these are market pricing growth and demand risk from an increasing probability of a recession here. But does that mean that inflation is definitely going to come down? Of course, it doesn't necessarily mean so, because things are fluid and can still change. And even if it don't, right, we can expect it to take some time for these prices to feed downstreams to consumers. So I would not be surprised if the upcoming CPI number, which is a lagging indicator for the previous months, to give a high print. Okay, but as it is right now, the market seems to suggest that demand is coming down. Okay, so this chart here gives you another picture on inflation expectations. It basically shows you the 5-year and the 10-year inflation break-even rates. So the inflation break-even rates are basically differences between the yields of the nominal bonds and the tips of the same maturity. Okay, so the difference between these yields is kind of like an indication of what the market expects inflation to be over the period considered. And it is quite clear from here, whether it's the 5-year break-even rate or the 10-year break-even rates, that the market expectations on inflations are coming down in a very clear trend. So this might suggest to you that inflation have already peaked. And if that is the case, then we might look towards bonds behaving back as safe havens once again. Okay, alright, so that's all I have for you guys. Thanks, and see you all the next time.